banks. Alexander Kyrtsis is Executive Director of European Banks Research at UBS, joins us in the studio now. Alexander, thank you so much for coming in. So what does the Euro Alpha Bank merger signify? Is this the start of serious consolidation in Greece's financial industry?
Well, yes, it is. I mean, we're seeing the second and third largest Greek banks merging now. We've been anticipating this move for a number of years, and it has now come. So if you're a smaller Greek bank now, you would want to merge with another one to attain this bulk and size that is very important now in this environment.
So this is a good thing. Is it a constructive solution? Is it going to shore up the country's financial industry, as we're hearing officials there argue?
Yes, absolutely. And it does also allow the banks to access capital markets in a much more effective way, funding and capital markets. And we're seeing this already with actually both Eurobank and Alpha, the merged entity raising capital with the participation also of Qatari funds. So this is very important.
Given the pressures that Greek banks are under right now because of their ongoing exposure to sovereign debt, but also the fact that economic conditions are worsening, there's very little loan growth, it's getting tougher to grow revenues in the current environment for banks right now. Is this going to be enough, or could they need further capital injections further down the line?
It's very hard to tell, and that's a very valid question. The environment is very challenging. What is certain is that this is a step in the right direction. It might not turn out to be enough, but at least it's a step in the right direction. The amount of capital that is being raised or that the merged entity is planning to raise of around 2 billion euros is certainly sizable, but it's of course too early to say whether this is enough or not. It depends on the sovereign situation as well in Greece, and of course on what the private sector loan portfolios, how they perform in this environment.
And could we see similar deals then across other Eurozone countries with banks that are burdened by sovereign debt? And could this be more of a private sector solution which essentially protects public money, taxpayers' money, from being injected into the banks?
Well, indeed. And especially for mid-sized European banks in troubled countries or countries whose sovereign is in doubt now, I think they could benefit significantly from merging and attaining this bulk and size, which is important, realizing the synergies and also attracting capital. And this indeed could be a way for the private sector to deal with this instead of let's say, the public sector having to inject capital or manage the situation.
So whereabouts could we see further consolidation then in Europe?
Well, mid-sized Italian banks, for example, mid-sized Spanish banks could do with more bulk. Those would be a couple of examples. And in Greece, like we said earlier, we'll probably see a domino effect, a chain reaction of M&A. But let's wait and see. A
chain reaction of M&A, so further deals to come in Greece as well. And I just wanted to ask you about this. We had a report in the FT, according to the EU's market regulator, some European banks and insurers should have taken bigger losses on their Greek government bond holdings. Is there a problem to the way many banks are approaching their write-downs on Greek debt?
Well, it's interesting because this is subjective. The banks have not marked down their holdings to the market prices of the bonds.
Yeah.
But the assumption there is that Greece will not default. That's the assumption. So what the banks and the insurance companies have actually done is they have marked down their bonds, the bond holdings down to what the agreement, the rollover and debt exchange agreement that has been made between Greece and the private sector debt holders.
What does that mean for the accuracy of the valuation?
Well, in other words, what they have done is they have brought down the valuations by around 21%. So instead of holding the bonds at par, they hold them now 21% discount to par. The bonds are trading at around 50 cents a euro, so or depending on duration. So there's more to go if one were to mark it down to market. But the underlying assumption is that Greece will not default, and that's what the accounting treatment is assuming.
Thanks. Alexander Kyrtsis is still with us, along with our very own Manus. So Alexander, let me pick up on that point about the sell-off in European bank shares being overdone. If it was in fact fear that was behind that rout, well, are we seeing now, attractive valuations have prompted a little bit more buying?
Well, what's really important about banks and the markets, of course, is confidence. And confidence was shaken in the beginning of August by the US downgrade, by the situation in the Eurozone, doubts about that. And as a result, there were fears that the money markets would shut down, like we saw after the collapse of Lehman Brothers. But now confidence is improving, and that's also what is leading this rally in the bank share price.
Do you think moves like Warren Buffett getting involved in Bank of America, and interestingly, Qatar supporting this deal yesterday, and they supported Barclays in 2008, does that send a big message about valuations, and it is time for sovereign wealth funds to really look at value in European banks?
Well, it does indeed, and I mean, those are all votes of confidence in European banks. Valuations are low, so we're talking about maybe 0.6, 0.7 times tangible book value for the European sector. For the Greek banks, which are much more troubled, of course, they're trading at 0.3, 0.4 times, and these are definitely votes of confidence that help sentiment.
Look, the single biggest conundrum every time we talk to somebody here is whether we've got... Liquidity is backed up by the ECB. Would you agree with that?
Well, yes, it is.
So then have we got a bigger... Is there still a solvency question in the European banks? Are you concerned about solvency? And if so, which countries?
Well, not necessarily, not solvency, but the question is whether the banks in certain countries can continue operating with the current business models. So a lot is changing. The sovereign is putting a lot of pressure on the banks. There's regulatory change as well with Basel III, etc., and that is what the market was doubting and may start doubting again sometime in the future.
Speaking about attractive valuations and countries like Qatar getting stuck in, on the other hand, you have US money market funds slashing their exposure to European banks, right? So does that highlight how dependent European banks are on short-term financing? How worrying is that?
Well, certain European banks have significant reliance on US dollar funding, money market short-term funding, and that was also one of the implications of the Lehman collapse, as the banks had to shorten their liability, the terms. And this is not a structural issue necessarily. Once confidence returns, the banks should be able to term out their funding again. So it's all a matter of sentiment and confidence. It's not a structural issue, we think.
Well, wonderful to talk to you. Alexander Kyrtsis, thanks so much of UBS.